Your next reading is Introduction to Industry and Company Analysis. These are the specific learning outcome statements, and these are the key areas to cover. Understanding the effect of business cycle, industry life cycle, Michael E. Porter 5 forces model, Michael E. Porter's competitive strategies, and finally the effect of price competition. Your first LOS is explain uses of industry analysis and the relation of industry analysis to company analysis. What is industry analysis and why is it important? In order to decide in which firm or industry to invest in, we analysts conduct industry analysis. Basically, it's a framework for understanding a particular industry and firms within that industry. For example, I want to focus on banking industry, right? So to better understand conditions of banks, I will conduct banking industry analysis to decide should or should I not invest. In an active management strategy where a portfolio manager will actively try to beat the market rather than just staying back in a passive management strategy, he can identify industries like banking and pharmaceutical, etc. He can identify industries that are undervalued or industries that are overvalued in order to weight them appropriately. So in active management strategy, what he will do, he will invest more in those industries that are undervalued. Investing more in those industries that are undervalued, this is called overweighting. And he will reduce his investments in those industries that are overvalued. And this is called underweighting. For example, let us say I have invested $500 each in these different industries, ABC, and a total investment of $1,500. And as per my analysis, industry B is overvalued and A is undervalued. So what I will do, I will move funds from B to A. That is, I have underweighted B and overweighted A, so as to keep my total investment still $1,500. And after some time, when I find industry A is now overvalued and B is undervalued, so I will move funds back from A to B. This is called industry rotation. Maybe I will move funds from A to C, right? So this is called industry rotation, and increasing and decreasing the investment composition is called under and overweighting. Next LOS, compare methods by which companies can be grouped, current industry classification systems, and classify a company given a description of its activities and the classification system. First of all, companies can be grouped into an industry. Let's say these four different colors, they represent different companies. These companies can be grouped into industry. This bigger circle, red in color, this represents industry. And many such industries form a sector. For example, the firms that produce medicine constitute the pharma industry. So these are the firms, and this red circle represents pharma industry, right? And many such pharma industries and many hospitals, doctors, pharmaceutical firms, many medical industries, together they form the health sector, represented by this biggest circle, blue in color. So such grouping is done on the basis of principal business activity. What is principal business activity? The largest source of sales or the largest source of earning. So this is what we take as a base to classify firm. There are many systems. We will discuss these one by one, like Global Industry Classification, GICS, Russell Global Sectors, and Industry Classification Benchmark. First, based on sensitivity to business cycles. What is a business cycle? We will discuss this in our later slides. Just for briefly, we will discuss here. Firms can also be grouped based on how they respond to business cycle, how they respond when there's a business downturn, how they respond when there's an economic boom. So when the firms are classified based upon their sensitivity to business cycle, So we can classify them either cyclical versus non-cyclical. We'll discuss these in detail as we move along. Second classification, based on statistical method. What does it mean? Under statistical methods, we can form groups of firms that have highly correlated returns. For example, let's say firm A here, B, C, D. These firms' returns are highly correlated. When A is giving high returns, B, C, D, they also give high returns. But there are many limitations to this classification, because historical correlation between these firms, they may not be the same in the future. The groupings that we have made, A, B, C, D, these groupings may change over time, may change across countries. Then we have industry classification system. They are based upon principal business activity we just discussed a little while ago. Means grouping is done based upon the largest source of sales or revenues. This is how we classify firms, based upon principal business activity. So these industry classification systems are further subclassified into commercial classification and government classification. Under commercial classification, we have GICS, that is Global Industry Classification Standard. This is developed by Standard & Poor. Each company is assigned to a sub-industry according to its principal business activity, as this is the base. There are 10 sectors, 24 industry groups, further subdivided into 68 industries and 154 sub-industries. As you can see, it's a 4-tier classification. Then Russell Global Sectors is based upon the products or services a company produces. It comprises of 9 sectors, 32 subsectors and 141 industries. So as you can see, it's a 3-tier system. And then we have one more, that is Industry Classification Benchmark. This was jointly developed by Dow Jones and FTSE. Companies are categorized based on their primary source of revenue, comprised of 114 subsectors, 41 sectors, 19 super sectors and 10 industries. So as you can see, it's a 4-tier structure system. Then our LOS requires us to classify a company given a description of its activities and the classification system. Alright, so basic material and processing. This is the categorization. What kind of firms would we have in this category? Building materials, firms involved in chemicals, paper and forest products, containers and packaging, metals, minerals and mining. Fine. Consumer staples. Consumer staples means food. Firms involved in production of beverages, tobacco and personal care products. There is another classification, consumer discretionary. These firms are cyclical and sell goods and services industries such as automotive, apparel and hotels and restaurants. Then we have energy. Firms involved in energy sector would be energy exploration, refining, production, energy equipment and energy services. The next is financial services. Financial services firms, banking, insurance, real estate financing, assets management and brokerage. Then we have, next is healthcare. Healthcare sector would involve firms related to pharmaceuticals, biotech, medical devices, healthcare equipment, medical supplies and healthcare services. Then we have tech firms. Tech firms will involve firms that sell or produce computers, software, semiconductors, communication equipment, internet services, electronic entertainment, consulting and services. Then we have telecom firms that may be wired or wireless. An important category is in utility, that is electricity, gas and water, and so on and so forth. So it's advisable to go through this list so that you know which type of firm is classified under what industries. That would be essential. Then we have government classification. ISIC, that stands for the International Standard Industrial Classification of All Economic Activities, was developed by the United Nations in 1948 to increase global comparability of data. Then we have SCEAC, that is basically Statistical Classification of Economic Activity in European Community. It is similar to ISIC, but it is designed for Europe. Then we have NAICS, that is North American Industry Classification System. It was jointly developed by United States. So the problem with these systems is that they differ from industry. The methodologies that government providers use in their compilation of industry groups differ from those used by commercial providers. So most governments do not identify individual firms in a group. They may include certain non-profit making organizations. They may include listed, non-listed, but that's not the case in these commercial classification. Here we have listed organizations, for-profit organization. That's the issue with, and then mostly the main issue between commercial classification and government classification is that government classification is updated less frequently, sometimes up to 5 years. The next LOS is explain the factors that affect the sensitivity of a company to the business cycle and the uses and limitations of industry and company descriptions such as growth industry, defensive and cyclical industries. First of all, what is business cycle? Business cycle, also known as the economic cycle or the trade cycle, are the fluctuations, as you can see, are fluctuations of gross domestic product, GDP, which we are quite comfortable with what the idea is. So it's the fluctuation in GDP and its long-term growth trend. As you can see, this is the trend in GDP growth and these are the fluctuations in GDP. So the length of the business cycle from one peak to another or from one trough to another trough, this is the length of the business cycle. It's the period of time containing the simple boom, contraction and sequence. The sequence, as you can see, is repeating. This is what we call business cycle. So this business cycle affects firms. When the economy is in upward trajectory, when there is economic growth, the GDP is increasing, firms, most of them will be doing well, but not all of them. When there is economic recession, most of the firms will be in trouble, falling demands, lower profitability, but not all. Okay, cyclic versus non-cyclical firms. Cyclical and non-cyclical firms are categorized with regard to their response or their sensitivity to the business cycle. Now, cyclical firm means those firms whose earnings are highly dependent on the stage of business cycle. When the economy is booming, so such firms will have higher level of revenue, higher sales, higher profitability. And when the economy undergoes recession, contraction in GDP, these firms will be in trouble. So such firms are characterized by high leverage, both financial and operating, and the items sold by such organizations are normally non-necessities, expensive. That's why when the economy is booming, people will buy more of these goods and services, but when the economy is in downturn, there will be less demand of such goods and services. So such firms are normally found in your consumer discretionary, mean automotive industry, automotives, apparels, hotels and restaurant businesses. They are highly influenced by the economic activity. When there is economic downturn, you will see less people buying cars, less people going for eating out. So this depends. And then finally, the other one, non-cyclical. Non-cyclical firms produce those goods and services which are more or less a necessity, for which demand is relatively stable. Like we need electricity, gas and water, no matter where the economy is currently standing. We need healthcare services. We need telecom. So such industries, such firms that are not greatly affected by the business cycle are called non-cyclical firms or non-cyclical industries. And cyclical firms and industries are greatly impacted by the changes in economic cycle. Then non-cyclical firms or non-cyclical industries can be further separated into defensive and growth. Defensive industries or defensive firms are those who are least affected by the stage of business cycle. So they would be our necessities like food products, drug stores, etc. Whereas Growth industries, on the other side, these industries or firms have demand so strong that they remain largely unaffected by the business cycle. So non-cyclical firms or industries can be split into defensive and growth. Next, explain how a company's industry classification can be used to identify a potential peer group for equity valuation. First, what is a peer group? A peer group is a set of similar companies an analyst will use for valuation comparisons. Similar with regard to what? Such firms may have similar business activities, demand drivers for its products or services, the cost structure drivers, and the availability of capital. So why do we need to form such a group? Analysts will need to make such group for valuation purposes so that firms can be compared. So to form a peer group, an analyst will often start by identifying companies in the same industry classification we discussed a little while ago. So there's a step-by-step approach of following steps to use to form a peer group. First, use commercial classification we studied just a little while ago. Use firm's annual reports. Such examination will help you see if the firm has identified its competitors. Normally in management and discussion section of the financial statements, you would see that the firm may have identified its key competitors. This could be one way. Then we can use industry trade publications to identify key competitors, and we can compare firms' sales and earning sources, confirm that comparable firms have similar sources of sales and earning, and finally, once we have identified, we may have to adjust. Like for example, I've identified two firms A and B, but one prepares accounts with regard to the standards prevalent in the US GAAP, and other follows IFRS. So we may have to adjust their financial statements so as to make them comparable. Next, LOS, describe the elements that need to be covered in a thorough industry analysis. A thorough industry analysis should include the following elements. First, evaluate macroeconomic trends. What are macroeconomic trends? Increasing interest rates, decreasing interest rates, rates of inflation, GDP growth rates trend, and how these macroeconomic trends are related with industry. If when interest rates fall, there is a growth in industry, or when the tax rates increase, there is a decrease in industry revenues. So it means we need to see how these macroeconomic trends are related to the industry performance. Then we will estimate and evaluate industry variables using different approaches, developing different scenarios, what-if analysis, and then we will compare our forecast of industry variables with those of the others so as to ensure that we are reaching the consistent conclusions. Determine the relative valuation of different industries. Then compare valuation across time, that how the valuations are affected by the changes in business cycle. Then analyze strategic group. Who are strategic group? Powerful firms in the industry. The big wigs, the big shots in a particular industry, their analysis will reveal the future direction of the industry. Classify industries by life cycle. We will discuss this later. Industry undergo different phases as it moves along across time. It starts from embryonic stage. Let me show you. This is industry life cycle. The different phases, different stages. Embryonic stage, we'll discuss this in our subsequent slides. Growth, shakeout, the maturity stage, and finally the decline. So we need to position the industry. Where does the industry is at the moment in the life cycle? Whether it's embryonic, growth, shakeout, mature, and declining. All right, then assess learning curve. What is learning curve? Learning curve is the reduction in the average cost as the experience is gained. Fixed cost per unit is spread out on a larger number of units. If your cost per unit and the units of production, your cost per unit tends to fall as the experience is gained. Fixed cost tends to be spread out on a larger number of units. This is called learning curve. It will also involve the impact of economies of scale. As the scale of operations are increased, average cost falls. We discuss it in detail. Purchasing economies of scale, technical economies of scale, risk-bearing economies of scales, managerial economies of scales, and so on and so forth. Then consider active forces. What forces that may affect the industry? Many forces: changes in the demographic environment of the economy, changes in the population, changes in the macroeconomic variables, governmental regulations can affect businesses, societal change can affect businesses, as well as the technological influences. These are the active forces that may greatly affect and influence in a particular firm or industry. Examine the forces that determine competition within the industry. There were 5 forces identified by Michael Porter. We'll discuss it in our subsequent slides. So we need to determine what are the forces that determine the competition in an industry, whether they are in your favor or they are against you. We'll discuss in the later slides. Next reading is describe the principles of strategic analysis of an industry. Industries differ markedly. They are different from each other. In some industries, there is less competition. Other industries, firms face severe competition, and this will affect their profitability. An analyst should understand that industry conditions, industry profitability can change as the time progresses. So industry analysis should be forward-looking, extended into the future. What is strategic analysis? Strategic analysis examines how an industry's competitive environment influences firm strategy. What is strategy? The course of action we take to achieve the mission statement. And what is the mission statement? Mission statement is the reason why does a business exist. It's the rationale behind the existence of the firm. So, in order to conduct strategic analysis, we use Michael Porter's 5 forces model. These 5 forces determine the industry competition. These 5 forces will determine industry's attractiveness. These 5 forces will determine the industry's long-term profit potential. If I want to, let's say I'm an investor and I want to start a new business setup. I'm not a portfolio investor. I want to make fixed investment. I want to start a new business. I want to start a new business in specific industry. I will have to assess these 5 forces to decide, should I enter this industry? Should I make investment, long-term investment in this industry, or should I not? Of course, I would like to assess the industry's long-term profit potential, the competitiveness of industry, as well as the existing rivalry in the industry. So these are the 5 forces that will determine the attractiveness and competitiveness of an industry, that will determine the long-term profit potential. Let us discuss these forces one by one. First, industry rivalry. Rivalry among existing firms. Rivalry among existing firms will be intense when an industry contains many strong competitors. They will fight with each other. There will be price wars, price cuttings, large advertising budgets, and frequent introduction of new products. So this would mean if there is intense competition, intense rivalry amongst competing firms, if a new entrants come, they will find it very hard to make profit, because intense competition means there is cutthroat competition on price, on advertisement, on product innovation. So new firms will find it hard to make profit in such a competitive, such an industry where there is intense competition. So this force, if it's against me, if there is intense rivalry, I should not enter such industry. So this rivalry is determined by the stage of the industry life cycle. If it's in maturity stage or decline, there will be stiff competition. But if it's in the growth stage, if the industry in the growth stage, then things tend to be good for every firm. It also depends upon product differentiation. If the products are highly differentiated, it means newer firms can come and they can offer a new product. It also depends upon the economies of scale. Existing firms may have achieved economies of scale. They might have achieved learning curve effect. So the newer firms will find it hard to produce at this low cost. Then next force is potential entrants. How easy it is for new firms to enter the industry. The prospects of long-term profitability of an industry also depend upon how easy or difficult it is for the new firms to enter. It will be hard for new firms to enter. The barriers are high if there is learning curve effect of if their existing firms are at such a low cost of production, they have achieved economies of scale, the newer firms will find it hard to break into this industry. Brand identity is strong. New firms will find it hard to take away the customers from other firms. Cost of switching supplier is high. Customers cannot, or they find it costly to move from one vendor to another, from B to C. So it is difficult for the consumers to move from one supplier to another. Existing firms have cost advantage. They are able to produce at low cost, so the new firms will find it hard. Product differentiation is high. Capital requirements are high. It is difficult to enter the market because large significant investment needs to be made in the capital. So far, I have found the industry to be marked by intense rivalry. I shouldn't enter such industry. High barriers to entry, so I can't enter. So the existing firms who are currently dominating the market, they will be making significant profits. So for a new entrant, it will be difficult to enter. So existing firms will be able to make more money, more profits. Third, threat of substitutes. What is a substitute? Substitute is a product or a service from a totally different industry that may prove to be a substitute of your product. For example, you are a manufacturer of wooden furniture, right? But another industry, steel industry, they uses steel fabrication and they start manufacturing iron-based furniture. See, it's a product from a totally different industry that may prove to be a substitute of your product. So if it is easy for other industries to make a product or service that might be a substitute to your product or service, then it means the profit potential is low, right? So if existing firms are competing stiffly, profit potential is gone. If it is easier for the firms to enter in the industry, everyone can enter, profit potential is gone. If it is easier for the other industry to produce a product or service similar to your product or service, then the profit potential is gone. Then, if your buyers are very strong, industry is dominated by few buyers and they are the one who determine the price. They are the one who negotiate. They have strong negotiation power, so they decide what the price they will pay. If your industry is dominated by few buyers, your profit potential is gone. And finally, the bargaining power of suppliers. Let's say you are a computer manufacturer, computer assembler, Acer, Compaq, HP, Dell. You use Intel processors. Intel is the monopoly in computer processor manufacturing. So your profitability is dependent upon the cost of Intel processor. Supplier is strong, they can charge more price and I have no alternative. So my profit potential is gone. So if finally, let us sum it up all. If industry has stiff competition amongst firms, profit potential is gone. Everyone can enter in the industry, profit potential is gone. There is a threat of substitute. Some other industry can provide a product service that is similar to yours, profit potential is gone. Buyers are very powerful. They negotiate the terms of trade, profit potential is gone. Your suppliers are very powerful. They can affect your cost of production, profit potential is gone. So these are the 5 forces which could either welcome you or they might go against you. And that's what we need to see before deciding to enter in a specific market. This is called Porter 5 forces model. Next, I'll explain the effects of barriers to entry, industry concentration, industry capacity, and market share stability on pricing power and price competition. First, we just discussed barriers to entry. How easy or difficult is it to gain entry in the new industry? High barriers to entry, if the barriers are high, it will benefit the existing firms because they may prevent new competitors from entering the market. So thereby, when there will be less competition, so they can generate more returns on capital. So how can we determine the barriers to an entry? We can determine the ease of entry in a particular industry if we can see that the firms that dominated the industries 10 years ago, the same firms are dominating the industry now. So it means the barriers to entry in this industry is high. The dominant firms are still dominating. No one has been able to enter the market and being able to challenge the leading competitor. And high barriers to entry doesn't mean that the firms within this industry, they will have high pricing power or there will be price competition. It depends upon the specific context. For example, cell phone manufacturer, for example, this industry has high barrier to entry because you need significant investment to start manufacturing mobiles. So having high barriers to entry doesn't mean that the mobile manufacturers, they can charge high price. They can't, because there's so many competing firms and they can produce on a larger scale of production. So the firms within this industry, they have less pricing power. I would say there's more price competition amongst the firm in this industry. Next is industry concentration. Industry concentration, let's say an industry dominated by 3 large firms and there are many small firms, and these large firms, they hold 80% of the market share. It means the power is concentrated only in the hands of these 3 firms and they are the one who call the shots. Now, since let's say one of these firms hold 40% share and other 2, one holds 30% and other holds the remaining 10%, for example. So the firm that holds 40% market share is quite a sizable market share. Having such a high market share doesn't mean that this firm can influence pricing. It doesn't mean that it has high pricing power. Why? Because these other 2 might collude against this leading firm. So industry concentration does not always mean that the firm having the largest market share can influence the pricing. Conversely speaking, an industry with low concentration, where a single firm holds 10% market share and the rest of the market is shared among many small firms, this single firm holding a larger market share with no close competitor, this firm will have the pricing power. This firm can dictate the pricing in this industry and it will face very less price competition from the smaller firms, because the smaller firms are not in a collusion with each other. They can't, because the market is quite significant in size. Then next vector is industry capacity. Industry can have undercapacity or overcapacity. Undercapacity means that demand is more than supply. So demand is intense, it's more than supply. Resultantly, this higher demand can result in higher pricing in this industry. So firm in this industry, they will have higher pricing power. They can generate higher return on their investment. Compare it with the overcapacity. Overcapacity means you are producing more but the demand is less. In other words, supply is more than demand. Since there is overcapacity, supply is greater than demand at current prices, so resultantly the demand is low, so the firms in this industry will not have the pricing power. And accordingly, the return on capital in such industry would be lower. 2 important concepts to remember for relating to industry capacity. One is that the industry capacity may be fixed in the short run, but in the long run, capacity can be changed. It's variable, can be expanded, can be scaled down. This is the first point to remember. Size of your plant, the productive capacity, building, production facilities, all relates to your industry capacity. So in the short run, they could be fixed, but in the long run, they can be expanded. And capacity is not always physical. It is not always plant and machinery or factory buildings, right? So if the capacity is physical, it will be difficult to expand in the short run. But in case if we're talking about insurance companies or banking sector, capacity can be quickly increased in such industries. But it is difficult to increase physical capacity in the short run, but non-physical capacity can be increased. For example, an increase in demand for insurance can be more easily and more quickly met than the increase in demand for a product requiring the physical capacity. Next point is market share stability. Market share that are highly variable. Your market share is 10%, 15%, sometimes 9%. If your share is variable, it means the industry is competitive. If the industry is competitive, it means the pricing power is less, and in fact there is more price competition. On the other hand, if the market share is stable, let's say I have 12% market share and it's almost the same for the last 10 or 15 years, indicating that I hold pricing power, I'm able to hold on to my market share, and there might be less price competition among the existing firm. Or maybe I have entered into a long-term purchasing contract with my customers, so they can't switch, so the switching cost is low. It is difficult for the customers to move from one vendor to another, so that's the reason firms in this industry are holding on to their market share. Your next LOS is describe industry lifecycle models, classify an industry as to lifecycle stage, and describe limitation of the lifecycle concept in forecasting industry performance. Industry, just like product lifecycle, industries do have lifecycle. They pass through these 5 stages: embryonic, growth, shakeout, mature, and decline. Let us discuss these stages briefly. When the industry is in embryonic stage, it has just started. The characteristic of this stage are as that we see slow growth in this stage because customers are not familiar with the product. Prices will tend to be high. Large investments is required because it's a new investment, new startup capital, which could be significantly large. So firms have not yet achieved economies of scale, so your production cost is high, hence prices are high. And since this is just the starting stage, so there is a high risk of business failure. If business is successful or if the industry is successful to complete this first stage, the next stage is growth. Whatever the product or service was offered in the market, it has gained market acceptance. So growth stage is characterized by customers' acceptance. New consumer will discover the product. Since there are just few firms, because the firms were reluctant to take the risk, so there were few firms, so less competitive pressure. Because of increase in productive numbers, more production, firms will gain economies of scale. This would reduce your average cost of production, so the prices will fall and the firms will start covering their cost, fixed and variable, so the firms will start earning profits. Next stage is shakeout stage. Shakeout stage is characterized by the reduction in number of the firms in the industry. Those who are playing at the margins, the marginal players who were just there as a profit seekers, but they were unable to compete in the industry, they will be kicked out. So shakeout stage means the firms, those who are not performing well, those who are marginal players, they will be kicked out. At this stage, the growth will slow down. There will be intense competition among the firm. Since the firms have invested in their capacity, so industry might see some overcapacity, demand being less, the capacity to produce is being more. So because of this, firm might not be able to cover their costs, so the profits will start declining. And there might be, as I said, increased business failures. The marginal players who were not able to compete will be kicked out. Then next stage is maturity stage or mature stage. At this stage, growth rate has slowed down considerably. Marginal players have already been kicked out, so just few firms will survive. So the market will evolve into an oligopoly, few firms dominating the market. And the barriers to entry will be higher now. It will be difficult for the new firms to enter because the existing firm, they might have developed brand loyalty, they might have achieved low cost structures. So it is difficult for the new firms to enter. And price tends to be stable at the maturity stage. Then we have the last stage, decline stage. This is the time that the industry is now seeing a reduction in the output. Rather, there is a negative growth. Firm will compete on pricing. There will be a downward trend in prices. And few firms, those who will be able to survive, they will consolidate, rest will exit. So for us as analysts, we should determine whether the firm is acting the way it should have in these stages, acting its age. Like the firm in the growth stage should reinvest in operations so as to expand. So firm's action must be in consistence with the specific stage the industry is going through. There are certain limitations to this model as well. Firms do not always conform, or should I say industry as a whole does not conform to this model, this framework. Order is not, maybe some firms or the industries are killed at embryonic stage. Some might see growth and they fail, and then there's immediately from growth to decline. There is no shakeout or maturity stage. So it is not for sure that the order is followed exactly in the same sequence. Some steps might be missed altogether. So next LOS, compare characteristics of representative industries from the various economic sectors. To illustrate, let us use the strategic analysis of aerospace industry. Major firms in this industry: Boeing, Lockheed Martin, Airbus, General Dynamics, Northrop Grumman, SpaceX, Rolls-Royce. Barriers to entry, very high. Barrier to entry to this industries are very high because very large, significant amount of capital is needed. So there are capital and technological barriers to this industry. Then industry concentration, very concentrated. Largest 3 firms dominate the global market. Influence of industry capacity on pricing, high. Pricing is determined by strength of brand, not production capacity. Next, industry stability, very stable. Market share changes slowly. Life cycle, this industry is still in growth stage. Aerospace industry is in growth stage. Competition is high. Demographic influences, the changes in the composition of the population on this aerospace industry, little not applicable. Government influence, very high. Government influence on these firms, Lockheed Martin, Boeing, Airbus, government influence, it is highly influenced by the government regulations. Government influences the decision making of these aerospace giants. Social influences, not applicable. Technical influences, huge, very high. High impact from technology. Business cycle sensitivity, these businesses, this industry is non-cyclical and it's defensive. Demand for planes are very stable. I'm not talking about from the point of view of those who take the aerial journeys. I'm talking from the point of view of the sales of these giants to different countries across the world. So business cycle sensitivity tends to be lower, it's non-cyclical. Next, describe macroeconomic, technological, demographic, governmental and social influences on industry growth, profitability and risk. Macro, this is quite a general LOS, doesn't require any technical knowledge. Macroeconomic factors, let's say just take interest rate for example. If interest rate go up, it will affect your demand, so the growth might go down. Profitability might go down. So this interest rate change results in interest rate volatility, and that's a risk, interest rate risk. Technology. Changes in technology could prove to be an opportunity or could prove to be a threat. If the firm embraces technology, it will see growth. More output could be produced. Average cost could be reduced. Results in more profitability. And risk, yes, changes in technology could be rapid, which might result in your existing technology to become obsolete. Changes in demography, changes in population, it could at the same time be an opportunity or threat, right? Changes in demography, specifically to your product, if the changes in population, there are more old people and you are providing healthcare services, then your business will see growth, more profitability, and changes in the demographic structure could pose itself to be a risk. Government assistance can help businesses grow, can become profitable, and changes in the government laws, regulations can prove to be a risk. Social changes, favorable social changes for your business could result in growth, more profitability, and if certain societal factors, certain forces go against you, it could put a risk for the business. Next, LOS describe the elements that should be covered in a thorough company analysis. So having gained a good understanding of an industry's external environment, an analyst can then focus on company's analysis. He can assess company's financial strength, financial weakness, how strong a business is financially, its products and services offering, and its competitive strategy. Michael Porter gave us a general competitive strategic analysis model. A firm may have a broad competitive scope. Maybe you are competing nationally or internationally, or it might decide to compete in a narrow small market. So whether you are competing on a national or international scale or in a very small market, Michael E. Porter gave an idea that firm can make more profits than the competing firms by doing either of these. Either you become a cost leader, you produce at the lowest cost. If the market price is 100, it's a competitive market, you can't increase the price. If you are the cost leader, you can produce at the lowest cost, so the gap between selling price and the cost of production means you get the highest profit. So this is one strategy that can work for you, can generate more returns than can generate competitive advantage for you. Second is differentiation, that you produce your product that's so different, so unique, that you can charge a premium prices for your product. iPhone. So either you become a cost leader like Chinese products, or you produce a product that is significantly differentiated, and that is in a broad competitive scope in a larger market. You can do the same thing even operating in a smaller competitive scope. You can focus on cost, produce at the lowest cost, or you can have a focused differentiation. So the point to remember is either cost leadership or differentiation. Being a cost leader or focusing on cost means you will produce at the lowest cost, thereby generating more returns, and differentiation means that your product is significantly different than your competing or competitor's product, thereby you can generate more returns for your business. Next, company analysis should include firm's overview, firm's operations, governance structure, strengths, industry characteristics in which the firm is operating, the product demand the firm is producing, the cost of production, the pricing environment, is it competitive market, is it a monopoly or oligopoly, financial ratios, we discussed previously in earlier readings, and then based upon this, projected financial statements and firm valuation. For conducting such analysis, analysts normally use spreadsheet models like Microsoft Excel. So care should be taken. Errors can be compounded over time because you might have made projections for 10 years, so slight error can magnify over 10 years. Errors can compound over time, so check which factors are likely to change. Since these models can be greatly influenced by various factors, so when such analysis is conducted, such forecasts are made, such valuations are done, there are various assumptions, and flawed assumptions will result in flawed valuations. If your assumptions are well scrutinized, thoroughly examined, this will result in more robust valuations. So that completes your LOS 11 and completes your reading as well.